Welcome. Today is Wednesday, April 5th. I'm Jeff Huge, Chief Investment Officer at JWH Investment Partners and the founder of Alpha Insights. And this is your Daily Five. Daily Five is the show where we go through the five most important charts to be focusing your attention on. But before we hit the first one, let's just give you a quick reminder of our newsletter, our investment newsletter, affectionately entitled Huge Insights, the Big Picture. We just published issue number 20 on Saturday, April 1st, entitled This Is No Joke. We didn't want people to be confused because it was April Fool's Day, and we are not kidding about what we're talking about in this. The newsletter actually details a lot of the key factors revolving around the recent banking crisis in Silicon Valley. We had the second and third largest bank failures in U.S. history occur last month. And the implications of that, I think, are significant. So we wanted to spend a good deal of time detailing those issues for our readers, and we would encourage you to take a look. If you're not currently a subscriber, you can subscribe for free. We do put the report in your inbox on the first Saturday of every month via email. And, we give you a pretty good preview of the newsletter. I think the first 4 or 5 pages are free. For those who like what they're reading and want more, there's an option to upgrade to paid for as little as $10 a month. And that not only includes access to the rest of the newsletter, which I think is like 20 pages long with 30 charts in it this month, but it also includes some perks. One of those perks is actually our weekly top actionable trade idea, which we deliver to your inbox every Wednesday. It's our Alpha Insights Idea Generator Lab publication. That's an institutional publication. It also includes some updated market commentary in the report. So you kind of get to follow our views week to week as opposed to just month to month. And then we also give some other special perks as well. They're kind of random and they're pretty good. We give some pretty good feedback on that. So give it a look. If you're not already a subscriber, you can find us on hugeinsights.substack.com, or you can go to our website, jwhinvestment.com, or we're also on Twitter at @alpha_insights. With that, let's take a look at chart number 1. Chart number 1, we've entitled The Tale of Two Sectors. What we're really looking at here in this chart is just March performance. And we've punctuated the performance of the major indexes by looking at 2 sectors, the technology sector and the financial sector. First, let me point out that the S&P 500 posted a 7.5% total return in the first quarter. That's year-to-date through March 31st. But within that performance, it's noteworthy that 10 stocks, Apple, Microsoft, NVDA, Tesla, Meta, Google, Amazon, Salesforce.com, Advanced Micro Devices, and Broadcom actually accounted for 90% of the gains. And just 3 stocks, Apple, Microsoft, and NVIDIA, accounted for 50% of those quarterly gains. So something to understand here is that we are in a very narrow market, and it's being led by technology. So during the month of March, the S&P was up about 3.7%, but the average stock was actually down 1.1%. That's taking the S&P 500 and equally weighting it across its 500 constituents. The average performance was minus 1.1% in price. The technology sector, of course, was the strongest sector. That's on the far left of the chart. As you can see, tech was up 10.6%. Financials were the weakest performing sector. They were down 10%. That's on the far right-hand side. Mid-cap stocks were down about 4.5% on average during the month, with the Russell 2000 down over 5% and the mid-cap 400 down around 3.5% or so. Tech actually is 26% of the market cap of the S&P 500, but Apple and Microsoft together account for half of that. They are a combined 13% of the S&P 500 right now, which is approximately equal to the weight of the entire financial sector. Financial sector consists of 73 stocks, so just 2 tech stocks, Apple and Microsoft, equal 73 financial stocks in the S&P 500. In terms of their influence on the index, It's market cap weighting, right? So, in our experience, we're just going to say this and throw it out there. A broad-based bull market in stocks cannot endure while the financials are in a bear market. And indeed, as we'll see in chart number 2, financials are in a bear market. Let's take a look at chart number 2. There is a bear market in small cap banks. There are small community banks, small regional banks. These make up the bulk of that 73 constituents in the S&P 500 financial sector. And the recent crisis in the banking industry has put the small and regional banks in the crosshairs of the market. We've seen deep losses in the held to maturity portfolios of these banks, which has raised solvency concerns. And in fact, led to a massive outflow of deposits and forced the Federal Reserve to step in and the FDIC to guarantee even uninsured deposits at 2 of the nation's largest regional banks, so that depositors wouldn't be wiped out with the takeover of Silicon Valley Bank and Signature Bank of New York. What's happened here is as cash is seeking a higher yield in money market funds or safety in the short-term treasury securities, banks are being forced to raise their deposit rates, or they're going to face a major funding gap. And so if they don't do this, there is a going concern risk in these banks, so they are forced to do it. And this is basically leading to an impending collapse in net interest margins. Banks make money by borrowing short at a low rate and lending long at a high rate. And as those deposit rates rise, that margin disappears. And so there's a risk that margin could go negative, and it's putting enormous amount of pressure on bank earnings, which is leading to much tighter lending standards right now. So the result is a credit crunch, which will further pressure book values at these banks, which in turn will pressure multiples on those book values. Banks peaked at a multiple of around 3 times book value. We're now trading around 1.5 times on average. Some banks are trading at half their book value. If you think about things in Warren Buffett's terms, he likes to buy things at a discount at less than 2/3 of fair value. Fair value is 1. Book value is fair value. And if you can buy it at a discount, that's a good deal, assuming that book value doesn't erode. So, what we're looking at here is a lack of credit growth hitting economic growth, which will further pressure wage growth, employment trends, and ultimately consumer spending. All of this spells recession in our view, and we think it's just a matter of time. Let's take a look at chart number 3. There is a bear market in large cap banks. Most investors believe that the problem has been contained to the regional banks, and that the so-called SIBs or SIFIs, the systematically important banks, JP Morgan, Bank of America, Citigroup, Wells Fargo, Goldman Sachs, Morgan Stanley, these have been identified by the Federal Reserve and other major banking regulatory bodies worldwide as being systematically important to the global financial system. They will not be allowed to fail. That doesn't mean that they're not going to be affected by the storm. In fact, deep losses in these held to maturity portfolios are proliferating through the SIBs as well as the regionals. They all did the exact same thing. And furthermore, both classes of these banks have massive exposure into the teetering commercial real estate mortgage space, which is seeing structural collapse in their ultimate underlying fundamentals. This is being punctuated by massive vacancy rates in office buildings and retail strip malls and malls in general. And so, these vacancy rates are at all-time record highs, exceeding 18% right now and growing very rapidly. And so the expectation is that, the net operating incomes of the owners of these properties are under pressure. They will not be able to make their mortgage payments. And right now we're seeing 7% of all CMBS, commercial mortgage-backed securities, that are basically the underlying loans, are in some stage of delinquency or workout in many cases. And so this is a big and growing problem, and it is going to affect all of the banks, whether they're big or small. In addition, The SIBs have actually deposited $30 billion with some of the most vulnerable regional banks, just in an attempt to try and stabilize depositor confidence. But this is now giving them direct exposure to the crisis. And finally, this net interest margin problem isn't just a localized problem. It is endemic to the entire bank system. Banks are all going to feel these pressures, and these tighter lending standards are leading to lower economic growth ultimately. Finally, I'd point out that the FDIC is funded by the banks themselves in proportion to their own deposit base. So, one way or another, a bear market will always call your bluff. And if we take a look at the chart on the preceding page and this page, you can see that these are clear, technical tops, big breakdowns below the neckline support in these classic pattern top formations of the head and shoulders and inverted cup and handle variety. They count measured moves considerably lower than what we're looking at right now. And so, the momentum is to the downside, and I do not see these things reversing until they completely resolve to their expected target levels or much lower. Let's take a look at chart number 4. Chart number 4, this is a bit of a rerun. We were on Dave Keller's show, The Final Bar, last evening, and we talked a little bit about this chart, but I wanted to highlight a couple of other factors here. And, the first one is the fact that this is a continuation pattern. So we're looking at a 4-year weekly chart of the S&P 500 in the top frame. And what we believe has been occurring since about May of 2022 is, the market's been in a lateral consolidation. And that appears to have traced out a 5-point reversal pattern, very commonly known in technical circles as a symmetrical triangle. Now, in technical analysis, and I teach a CMT exam prep course for level 2 and level 3. And one of the concepts that we address in the pattern recognition area of the level 2 exam prep is that, these consolidation patterns of this nature are indeed continuation patterns. Triangles are known as continuation patterns in technical analysis. And basically, as such, they have a very high probability of resolving in the direction of the preceding trend. Now, the red arrows that we've illustrated on the chart, suggest that the preceding trend was decidedly to the downside before this symmetrical triangle pattern evolved. We are now at the point that one would suggest that pattern is at its end, if not nearing its end, and that the resolution should follow to the downside. That will be confirmed upon a sustained breach below that lower boundary of the pattern, and more specifically, taking out the, I believe, the March 13th low, which is that higher low in the pattern. And a breach of that level would confirm that we are on the way to the downside. I believe that level comes in at 37.64. Now, that being said, I also want to draw your attention to the middle frame of this. This is the percentage of S&P 500 stocks that are trading below their 50-day moving average. This is as of around 10 a.m. this morning. And as you can see, at each of the recent advancing legs of this pattern, okay, from the October 13th low, we can see a couple of attempts to move higher. And in each attempt, that percent of S&P 500 stocks that are trading above the 50-day moving average is lower at each subsequent high. And so, our point here is that we're seeing a narrowing of breadth, a diminishing of breadth. And that can also be, shown as being evident in the equal weight S&P 500 index underperforming the cap weight index itself. And so that underperformance, again, suggests a diminishing of breadth. And in fact, that is indicative of the notion that the consolidation is either complete or very nearly complete. And so this would be a condition that we would expect to exist before a reversal. And that's what we expect if, in fact, this pattern is a symmetrical triangle, which it clearly appears to be. Let's take a look at the chart on the next page. Chart number 5. This looks at this entire dynamic through a different lens, through the lens of the Elliott Wave principle. As those who have followed our work in the past know that we spend a good deal of time analyzing each and every wave of the index's performance, and we do this not just to the S&P, but we look at all the indexes, including the S&P equal weight. But the S&P is what people focus on, and we want to direct your attention here and now to the daily chart of the S&P, going back to the August 16th high, which we have illustrated in the past as being primary wave 2, a second wave high in a motive wave. So what we're looking for is primary wave 3 down to unfold, and we believe that's in progress. And it's simply subdividing here. And this lateral consolidation that we've seen is really a subdivision of primary wave 3. And so if our preferred count, as we've illustrated it here, is correct, then the decline into that October 13th low was intermediate wave 1 down of primary wave 3 down. And the 3-wave advance ABC into the February 2nd high is intermediate wave 2 up of primary wave 3 down, which means that we are in the very early subdivisions of intermediate wave 3 down of primary wave 3 down, a third of a third wave decline. And where we think we are in this process right now is, number one, we believe the decline from the February 2nd high into the March 13th low, a 5-wave decline, we believe that was minor wave 1 of intermediate wave 3. And the 3-wave counter trend advance, ABC, into yesterday's high, the April 4th high, was very likely a termination of minor wave 2. And one of the reasons that we think that that's the case is that we saw a key reversal day yesterday, a bearish engulfing or an outside down day. That's where the market opens higher than the prior open, makes a new high, then closes lower than the prior open. And so we've got, a range that exceeds the prior day's range and an engulfing of the body of the candle, taking out yesterday's body, and then some follow through to the downside today initially. And so that would suggest that we saw a key reversal yesterday right above the 78.6% retracement of minor wave 1, but also right on the 50% retracement line of the entire bear market decline from the January 2022 high into the October 13th low. That was also significant. And we also ran right into the upper boundary of that trend line coming off the August 16th highs and the February 2nd high. And then we saw the top of the parallel trend channel of this entire ABC achieved as well. And so all those things suggest that we're probably ending or ended minor wave 2. What does that mean? It means that we are in the midst of a third wave decline at 3 degrees of trend, minor degree, intermediate degree, and primary degree down. And if that's the case, once we breach the wave B low, which comes in around 3909, that would strongly support the idea that minor wave 3 down is operative. And then, of course, a breach of the December 22nd low would confirm that a third of a third wave decline is indeed underway. Now, where we might be concerned is if the market were to reverse higher, right? And if it took out yesterday's high, and in fact, then went on to take out the February high, we would start to get very concerned that our view on this count is potentially incorrect. We have an alternate, but if we got above, say, 4230, which is the 88.6% retracement of the decline off the August 16th high, we would probably say that this view is incorrect, and we'd move to our alternate count, which would suggest we have some additional potential up to around 4,300. But at this point, we don't see that as a high probability. And so our view is that, we should expect a significant decline in the index itself in the days, weeks, months ahead. That's all we had today. So first of all, I'd like to just invite you to take a look at our website at jwhinvestment.com for if you have more interest in our work. You can also follow us on Twitter at alpha_insights. And of course, you can find our newsletter on Substack at hugeinsights.substack.com. With that, I want to thank you all for watching today and wish you all the best of luck trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.